Good afternoon, everyone. This is Robert Rayburn, and I am joined by our analyst and head of financial planning over here, Tim Devlin. And we would certainly want to welcome everyone for another episode of the Life Pro Asset Management Market Update. And it could not be more relevant and more important to be doing this update, given a lot of the volatility that has really been afflicting markets here over the last, I would say, 7 days. But the reality is, if we take that and stretch that back to, the GameStop days, the AMC days of just the last week of January, we know that markets have been, certainly posing a lot of challenges for many people over the very short term. But the good news is that we continue to move that value line upward. And that's going to be our focus today is, what type of playbook can we put into place when we go through these short-term corrections in the market, which, by the way, are healthy. We want them. We need them. Why? Because it creates sustainable long-term upside as markets advance. Now, Tim, I don't know about you, but certainly I would love to live in a world where stocks and markets and asset prices go up, tick, 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 up every single day. But we know that's just not sustainable in the real world. We need the rest. We need the reset, similar to how all of us, I assume all of us, sleep on a daily basis. Why do we sleep? Our bodies need to recharge. What do market corrections serve investors and the broader market? It is the market's going to sleep so that they can recharge before they move and advance upward when we are, in particular, in a long-term bull market. So, Tim, what are you hearing? Like, what are clients concerned about right now when you're speaking with them? What are you hearing from advisors that we can answer as we sort of get through what I think, and I don't, please, people do not quote me on this, but I do believe that here, based on our work, that we're probably in the 7th to 8th inning of this stretch of volatility. There are a lot of things there that we like right now. We're going to go through that, but Tim, take it away.
Yeah, I mean, I think the big thing you're seeing just in the past week or so is that volatility. Especially Monday and Tuesday, we saw a lot of volatility intraday.
Absolutely, yeah.
So big movements within the day. So that's a lot of the client calls we're getting. The other side of it is people are concerned about rising yield rates. I would say a lot of that is just due to headlines, kind of pushing that theme along. Because as clients get peppered with it, it's hard to ignore. So sure. I think a lot of the things we're going to talk about today are very relevant to both of those topics.
Yeah, that's bang on, Tim. I mean, I think that when you look at what's been afflicting the markets from a headline standpoint, it's certainly has been the so-called move up in interest rates. We're going to dispel a lot of that today. I mean, just to kind of cut it short here, 1.3%. Like people, let's take a step back and put things into perspective. In February of last year, before COVID hit, we were significantly above those levels in terms of interest rates, and markets were healthy. So overall, from a historical standpoint, money is very, very, very cheap. But we're going to go through that stuff today, and certainly anytime you get volatility. Yesterday in particular, so let's see, they were recording this on Wednesday. Tuesday was a crazy sort of intraday swing movement that we saw. And now the good news, Tim, is that when you do see those huge sort of whitewash sell-offs right at the open, and then you sort of leak upward to the point where we pretty much close flat after being down more than 5% at the open, I think that when you see action like that, that is reflective of sort of that cascade selling where sort of the weakest hands finally fold, and you sort of get that last final push of selling. That's one of the most bullish things that we can see. I actually don't like when we're going through corrections where you actually get the market that opens up 2%. One rule, ladies and gentlemen, is that when we are going through a correction and we do get a nasty day like Monday, which was actually our nastiest day of the week, from a market close standpoint. The last thing you really want to see is the market open up 2 or 3% the next day. Tim and I were talking about this the other day. I don't know who actually buys futures overnight and bids the S&P minis up, 2 or 3%, because almost every single time you can short them and the market's going to retest the lows, if not break the lows, to finally press that final thrust of selling before markets actually do bottom sometime in the middle of the day or in the middle of the session the next day. So, or that could happen the next day after or whatever, but it usually happens during the session, not overnight. So that's one thing to watch, ladies and gentlemen. Don't get too caught up in the futures action. If anything, when we go through market sell-offs, we do want to see actually futures flush lower, so we flush out the last sellers. And I think we saw, if not most of it, certainly a good chunk of it on Tuesday. But let's go ahead and get started. I know we got a lot of people here who are very busy, so we don't want to take up too much of everyone's time. Now, Tim, can you see my slide? It says Market Correction Playbook.
Yep, I can see that.
Excellent. So I came across a great quote, ladies and gentlemen, and I think it really plays to what we coach on, to what we try to walk clients and advisors through on a daily basis when it comes to at least our investment strategies and investing in general. And that is, markets are designed to separate weak people from their money to enrich those who maintain their beliefs. It's a very powerful quote. And why is that? Because we know over the very, very short term, markets can rattle our cages, right? We can come in to work, or we can, if you're a home gamer, we can log into our computer and we see that red, right? We see that minus sign and that number, and we get that queasy feeling in our stomach. And the truth is, it's all noise, right? It's, tomorrow if we have a big update, that's noise as well. The day-to-day moves are noise. What's not noise is the substance and value that companies are creating or destroying on a daily basis. That's our job, is to make sure that we're invested in companies that are creating value over and above the broader market over time. But I think it's such a powerful quote. So a few things that we want to make sure that we're getting across this week. Pullbacks are normal and they're frequent. This is not going to be the first pullback that we go through, and it's certainly not going to be the last. In fact, since December, we've had 3, right? And December's pullback was actually greater than, at least for our strategies, than what we've had so far this time around, and actually quite comparable to just 2 or 3 weeks ago. In fact, even with all the noise, we're actually up in February. So I think we just have to put all these things into perspective. I think, sometimes we can get a little bit spoiled with some of the short-term action when things just go up in a straight line. This keeps us honest. This keeps us in check. This keeps a lot of that froth from blowing out of control. Second point here, Tim, stop loss strategies are a terrible, terrible investment strategy. I know there's a lot of positive press about it, but the truth is, what stop loss strategies do is that they cave into our emotions. You should have a stop loss strategy, but based on fundamental value and holding companies accountable, making sure that they do what they say they're going to do, not on short-term price action, because that doesn't mean anything. And lastly, the credit markets are strong, ladies and gentlemen. They haven't even flinched through this entire thing. And I think that's a really, really important point. We talk about this every week, and there's a reason why the one common denominator across all of our weekly updates are the credit markets. The credit markets are the foundation of our economy. They're the foundation of markets. They are the foundation of enabling consumers and businesses to gain access to capital at a reasonable rate so that they can create value, create jobs, and help the economy continue to grow on a day-to-day basis. So real quick here, as we always do, we like to be transparent in terms of our performance. We've had about a 6% pullback. That's again, that's normal. You're going to have that every couple of months, in my opinion. So, we're up just under 4% year to date over 1 year, up 90.54%. So 74% ahead of the S&P 500 after fees. And then that since inception number up 240.51%. What's the message here? Don't get caught up in the short term. If you listen to the press over the last week, you would think that things are falling apart. If you remember our January wrap up update, we were up 1% year to date at the end of January. So we're actually up in February. So we've had a nice round trip a little bit, but it's been volatile. But we're still creating value, and that is the key. And these are as of February 24th. This next slide is called avoiding the kill zone. Okay, kind of a scary title, but I got to give Tim credit here for creating this amazing chart. I think it's one of the most important charts that we can pay attention to here. Every 3 or 4 months, we got to put out one of these updates, right? Because the markets pull back 5 or 6%, sometimes 10%, sometimes 15%. March of last year, certainly more than that. This is the kill zone, ladies and gentlemen. This is where markets end up really hurting investors' long-term returns because they get shaken by the short-term noise. Warren Buffett had a great quote. He says that markets are a tool of transferring money from the impatient to the patient. And there's a reason why one of the wealthiest people in human history says that, because he uses that to his advantage. Effective investors, the wealthiest people on the planet, do this time and time again. The people who don't do that are not part of the 1%, not part of the 5%, not part of the 25%. And there's a reason for that, because markets are so effective at driving our emotion. Our emotion is the #1 detractor to performance. Now, Tim, when you put this chart together, what were you trying to look for when you put this chart here on the left together?
Yeah, so I think the big message, and it kind of ties into all the things you've already talked about, right?
Yeah.
What we don't want to do is act on emotion, because these drawdowns, they happen, right? They're normal. And like you said, in some respects, we want them to happen. But what's important to understand is you're going to get these drawdowns. And if you understand what you own, you understand the broader picture going on in the market, that point of pain is also the greatest point of opportunity, right? So we want clients to understand that, understand what they own, and see those drawdowns as opportunity for your future wealth, right? Your ability to grow later on.
Those are absolutely fantastic points, Tim. And what, ladies and gentlemen, the chart on the left is a very, very telling chart. So what that is the drawdown experiences of clients that were in our Life Pro Asset Management Tactical Opportunity Strategy, right? So every time you see the line go down, that is a drawdown that has occurred since April of 2020. We did not include March of last year. We all know we're 20-30% drawdown, but we wanted to talk about a more normal environment, even in an environment where markets are going up quite a bit. And the reason why I bring that up is because that's where people really make mistakes. It's natural to be nervous during something like March of last year, but where people really start to make long-term mistakes are these normal 5 to 10% pullbacks. And we can see here about a 7% pullback that we've had off the previous high watermark in mid-February, Tim. And the reason why that's important is that's actually been our shallowest pullback over the last 6 months. And so if we look at in September of 2020, we had around a 12.5% pullback. If we look in around this August time period, we had about an 8.5% pullback. If we look at that pre-election in October, we had close to a 10% pullback. Then we had another 10% pullback in December, and then another 8% pullback in January. And now we're having a 7% pullback. Now, why talk about all this? Well, this is the chart on the right about the value that our clients have experienced over that same time period. Over that same time period, so not off the bottom in March, but sometime in April there, up 150%. And here's the key point, ladies and gentlemen, is that had you caved into your emotions during any of these temporary shortfalls, you would not have experienced these returns. That transfer of wealth would have gone away from you to those clients and investors and stock market participants that were buying that valuable merchandise that was temporarily on sale. You can see here, every time there's a blip, that's a temporary moment that asset prices go on sale. And then they immediately go back to not being on sale. That's an important point. If you react to that, your value line shifts from being up 150% all the way back down to here. Whoops. And so the number one detractor to long-term returns is how clients navigate, how portfolio managers navigate, because institutional investors are just as guilty of this as retail clients, of caving into that short-term emotion. And one of the reasons why we say our clients and our advisors are in my opinion, some of the smartest in the industry, is because I can gladly say 99.9% of our clients just simply do not react to these blips. They have taken to our coaching, they've taken to their advisors' coaching, and if anything, we see an increase in those contributions through these periods of uncertainty. And I'm glad to say that as we've gone up over 100% over the last 12 to 14 months, that most of our clients have realized most of that return. And that's because they haven't let themselves get distracted by these short-term blips in the market. Now, let's talk a little bit about what's happened here in the last day or two. Quite simply, and we talk about this, if you remember, this chart should be familiar to people who watch our market update on a weekly basis. We've used it a number of times. It's, every time we get one of these rotation trades, it's quite simply the best performing stocks have got basically walloped for a day or two. Meanwhile, everyone rushed into the last 12 months' worst performing stocks. Well, guess what we don't do, ladies and gentlemen? We do not go and invest in bad companies to try and scrape return off the top. That's not what we're about. We're about investing in fantastic, great companies that are going from good to great. We don't want to take that risk because we know at some point the bill's going to come due and investors are going to realize, oh, wait, I hold a bad company. And suddenly those stocks go back into free fall. We want to own good franchises. We want to own dominant franchises. We want to own franchises that are monopolistic in nature. And so that's really the point of this chart here, is to really sort of show that performance divergence over the last day or two. It's noise, ignore it. Stay focused on quality, stay focused on secular growth, and we believe over time you'll do well and make money. And you remember last week, this is the chart from last week, the background chart. We said the markets were a little bit overbought short term, but we're not smart enough to try and guess when that 5% pullback is going to be. No one is. What we have to do is stay concentrated on what we're good at, which is staying focused on franchises that are building enterprise value day in and day out. Again here, just real quick in terms of the NASDAQ, because the NASDAQ's sort of been at the center of this storm. What we see here is the NASDAQ had about a 12.6% pullback in September, another 10% pullback in October, a 5% pullback in late December, and then in late January, and then of course now about an 8.26% pullback in February. It's normal. We're just experiencing another period of digestion. I think that's important. Over the last 6 months, we've had 4 material pullbacks. We just can't get shaken out by that sort of stuff. Wouldn't you agree, Tim?
I would agree. And I think another point, kind of talking about the timing aspect, right? where we don't want to try to avoid these small blips in the market is you can kind of see back in October there, that recovery was very sharp also, right? So if you're not back in the market,
Yeah.
you have that opportunity to lock in those losses, miss out on those sharp gains, and you're a couple steps, behind of where you could have been had you just stayed in the market, right?
Yeah. Oh, we hear this all the time. And actually, you're on the front lines, Tim. Like, we'll hear, well, I want to take my money out for just a couple of weeks and then I'll get back in. Big, big mistake, because it's that 2-week time period where you recover most of your value. The reality is that markets are never going to go to zero. Solid companies are going to do well over time. And yes, we're going to have that noise, but you got to ignore it. And honestly, I'll just say what I do with my own accounts. So I don't even look at them sometimes, right? And so, I look at our strategies on a daily basis. It's what I'm paid to do. It's my compensation. It's what I do for a living. But for my own personal accounts, that's where emotion can creep in. I just don't look at them because I know that I own these assets for a very long period of time. In the same way I wouldn't sell my house just because the real estate market goes and is temporarily weak for a few months. No one does that with their real estate. Don't do that with your solid franchises. We're in a good market. We're in a solid economy, and over time that value will accrete. So I wanted to put together this chart for a lot of people and to really talk about what does secular growth look like? And really what this blue line is, ladies and gentlemen, is what we call the value line. So that means a company that is able to sell more widgets over time, right? So if they sold one widget in year one, they're able to sell 2, then 6, then 8, then 20, then 40. They're able to sell more widgets over time. They're also able to maintain and eventually reduce their expenses as a percentage of their overall net sales. That creates enterprise value. We're looking for companies that over time can create more and more enterprise value at an accelerating rate for their investors above and beyond what can be accrued on an enterprise value basis by investing in a low-cost index product. Now, if we think of prior companies that did an excellent job of that, such as Amazon, Apple, Google, Netflix, Facebook, most of these companies had lines like this. But how many investors actually fully realized the value of those companies and stocks over the 15-year time period that they were in hyper growth mode? The reality is that very few investors actually did. Why? Because of the squiggly line that actually is the realized path to creating value over time. It's never the dotted line, ladies and gentlemen. The dotted line is the fundamental value over time. And actually, if it was more accurate, it'd be more like an arc. The real experience is this squiggly line, right? So stocks are constantly in what we call positive or negative momentum. They're never usually in neutral momentum. They're either in positive or negative momentum. We're constantly shooting between an optimism overshoot or during a pessimistic overshoot. And it's just a matter of filtering out that noise and making sure that this dotted line is increasing over time. That's how we need to look at investing. So for example, we have DocuSign, which we love as a company. It's gotten killed the last 3 days. Has anything changed at the business level that says, hey, you know what, this company is materially worse than it was 3 days ago? No, in fact, we're pretty sure their sales have been growing over the last 3 or 4 days. So again, this is just a great example of what secular growth looks like, but then also the realized path to secular growth. The second chart around secular growth is we want to answer a question that we got from one of our clients. And that question is, when do we sell? Do we have stop losses? And as you'll know from the title there, we absolutely despise stop loss sell strategies. And there's a reason why. And it's because you can get caught up in that short-term noise. Algorithmic trading, more and more computerized programs that go through that can shake people out. And we're going to go through a couple examples today. So, but how do we do it? And basically, if we look at that blue dotted line here on the screen, Tim, what we can see here is we're looking for companies that can build value over time upward and to the right, but it can't just be upward and to the right. It has to be above and beyond what the index is creating. Because if we're not creating value over and above what the index is creating, then why are clients paying us 1%? It makes no sense. So we got to focus on companies that are improving that enterprise value and benefiting from secular tailwinds. If this blue dotted line ever falls below the green line, that's where so in other words, that hypothetical value line, that's where it would enter our sell zone. And it's not just below. I mean, if it even approaches that green line, we're like, listen, at the end of the day, if we can basically replicate 90% of the return by owning the index, why bother owning the stock? There's got to be better businesses out there that we can invest in. So to the client that asked that question, this is absolutely how we determine a sell. If that value line approaches the S&P 500, so ballpark say 80 to 90% of the S&P 500 return, 80 to 90% can be replicated by an index product, that's when we will sell that stock and look for a better business to buy. Okay, so I know this is the part of the presentation that a lot of people wanted to focus on, which is some of the noise of the last few days. Why don't we use stop losses, ladies and gentlemen? It's quite simple. Look at this chart. On Tuesday, the NASDAQ opened down 3.92%. I mean, it was a gut punch to everyone that opened their accounts between 6:30 Pacific, 7:30 or 9:30, 10:30 Eastern. It was a nasty open, but like for us, when we're looking for the end of corrections, a very healthy one. But think of this. Imagine if you had a stop loss, ladies and gentlemen. You get stopped out, market's down, you're like, oh my God, thank God I'm out, down 3.9%. And then look what happens. The NASDAQ rallies and goes up 3.5% to the point where it's practically flat for the day. So you basically had a transfer of wealth from yourself. You sold assets at a very temporary distressed price and gave it to someone who was opportunistic, and they immediately made 3.5%. Let's take this a step further. Snap, which is a stock that we own in the portfolio, got clobbered on the open, down 10.46%. If you look at a lot of strategies out there, they're going to say, hey, if a stock moves down 10% or more, that triggers a stop loss. And a lot of people are like, oh my God, that's great. The problem is most of these moves are garbage. Most of them are noise. They're distractions. There's nothing fundamental that took place with Snap between 6:30 and 7:30 on Tuesday. Nothing. Nothing happened with the business. It's just that the overall market went down. But then guess what happens? An executive from Snap comes out and says, oh, we're going to be experiencing massive revenue growth, not just this year, but next year, the year after that. That's what we call, ladies and gentlemen, secular growth. So what we've been preaching for a long time is that this is not about work from home or reopen. It's about buying good businesses that can grow in any environment. Look what happened. From that low point when a lot of investors got stopped out, Snap rallied 23.88%, absolutely bananas, and closed up 11% for the day. So, that's just another great example. Another one, Tesla. We don't own Tesla, but we know a lot of people follow Tesla. Got slammed down 13.35%, triggering stop losses across the board, then proceeded to rally 13%. And then was up today, I think 3 or 4%. So again, let's avoid that wealth transfer, ladies and gentlemen. This is, again, great examples of transferring wealth from the impatient to the patient. Be patient. All you had to do in this case was be patient by a couple of hours, but many people weren't. Why? Because of stop losses. Please, 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 ladies and gentlemen, avoid stop losses. They're not good strategies. They are simple tools of wealth transfer from the impatient to the patient. So let's go through a couple other things here. So the reopened stocks, we've heard a lot about them, right? Now, here's the problem here in the very, very short term, is that a lot of these stocks are getting overbought. So right away, this is the XLF. This is an index of bank stocks. So you know, Citigroup, Bank of America, we can go JP Morgan, et cetera, et cetera. You see here, they've had a nice strong rally, but now we're getting to a point where they're pretty overbought on the RSI, to call it 1 to 2 standard deviations overbought. Now, I'm going to share a chart here on my Bloomberg, and Tim, just let me know if you can see my screen. It's going to be Bloomberg screen here. Do you see that?
Yep, I see it.
Okay. Again, I apologize, ladies and gentlemen. I always have this Ethereum chart up. I love Ethereum. I think it's a great asset over the next 10 years. It's something we're doing more and more work on, but not the point of today's presentation. Okay, so let's look at the 10-year yield, the scary 10-year yield. Well, ladies and gentlemen, we know that the 10-year yield has moved up into scary territory. Cost of capital is spiking through the roof, right? Well, let's maybe hold off on saying that for a bit. So right now, what we see here is we've certainly come off the lows. We are at 0.5% on the 10-year yield. We got over above 1.4 earlier this morning, but look what's happened. We are now 3 standard deviations overbought on the yield. In other words, bonds are 3 standard deviations oversold, because remember, yields go up, bond prices come down. We're 3 standard deviations oversold. So we line up what we saw with the bank stocks in that last slide, overbought. We look at the 10-year yield, another function of this reopen trade, overbought. Ladies and gentlemen, let's look at copper, right? Dr. Copper. If we look at copper here on our trusty Bloomberg screen, so what we're going to do is we're going to pull up that chart here. We're going to look at the RSI. Again, we love copper longer term, but this is massively overbought. I mean, we're talking beyond 3 standard deviations overbought. And if we look at just the space between the 50-day moving average and where copper is, that's an issue, right? And so when we see that flush selling that we saw in a lot of those secular growth stocks back on Tuesday, and then we line up the points of evidence, ladies and gentlemen. So one of the things we like to do is not look and just pick out one data point, but we want to see alignment across the board. We want to see consistency and persistency. Copper, overbought. We have the bank stocks, overbought. The most important, the 10-year yield, overbought, right? Energy, overbought. When all of these things are lining up, the airlines overbought, the cruise liners overbought. That tells us, when in combination with 2 standard deviations oversold selling on the long-term secular growth stocks, that tells us that we're sort of flushed near the end of this overall growth correction in the market. That makes us very excited. We're out there picking around for merchandise. And so again, this is just a great example of not letting us get distracted by you know, the junkier stocks that can temporarily rally. So I'm going to go back here real quick over to our slide deck. You see our slide deck there, Tim?
Yep.
Awesome. So again, we talked about that 3 standard deviations overbought. And then this was a chart that we talked about last week, and we think it remains relevant, is that stocks will continue, in our opinion, based on our homework, to really, at the end of the day, outperform bonds. Why? Because we have an earnings recovery underway, we have an improving economy, and we have bonds that are being artificially suppressed by the Fed. And when you combine that with 1.5% to 2% inflation, you're losing money on those bonds. Stocks are where the value is right now. So again, from a relative point of view, Tina, there is no alternative. Pressing down on that air mattress. So air goes from the point of maximum resistance to the point of least resistance. That point of least resistance, ladies and gentlemen, in our opinion, based on our homework and data, remains the stock market, and in particular over time, those secular growth leaders that we like to focus on. And this is what we were talking about, the credit markets. So when we look at the credit markets, we see absolutely not even a symptom or a blip of nastiness in the market. Credit spreads, implied credit risk remains at near cycle lows. You would see widening. I mean, this is just a spike here, which, by the way, ladies and gentlemen, is about nowhere close to where we were in 2008. But this spike here, very emblematic of the temporary distress caused by the COVID shutdowns in March. What we see here, absolutely nothing. You need to see disruption in the credit markets to really say, hey, there's serious cracks in the system. Something's wrong. We got to take action. And I think that's really important, is that we're not seeing that here. And I'm going to just share a few more charts before we wrap everything up. So can you see my Bloomberg screen here again, Tim?
Yep, I see it.
Excellent. So we're going to look at here real quick, the credit default swap market. 1 second here. What's going on? Oh, there we go. Okay, so first we're going to look at high yield bonds. We look at high yield bonds, ladies and gentlemen. What do we see? We, at the end of the day, see falling implied credit spreads, right? Well, let's look at investment grade. So let's actually do this. Let's make our lives easier here. So we're going to look at not just investment grade, we're going to look at emerging markets, right? Emerging markets, like certainly something that, you know, if there's risk anywhere, it should be in the emerging markets. So let's just do this real quick and then pull up the good old chart. Sometimes this takes a second, but again, what you can see, not even in the emerging markets. So we're talking Indonesia, we're talking Thailand, right? These types of Latin America, so Brazil, Chile, Argentina, Colombia, these types of issuers, South Africa, are seeing credit spreads near all-time lows. Again, if we were going into a market that was increasingly distressed, and you would see for sure that play out in emerging markets, because it's kind of one of the riskier corners of the credit market. So I think the fact that junk bonds are near cycle lows in terms of that implied credit risk, emerging markets near cycle lows in terms of implied credit risk, I think really speaks to the fact that the foundation in the global capital market system right now remains quite strong. So I'm going to go back here and we're going to wrap everything up. Any other questions that you're getting, Tim?
No, I think you covered a lot of what's on people's mind kind of in the past couple of weeks, right?
Yeah.
I think prior to that, you know, a lot of these concerns weren't as high, and certainly it was a sharp transition kind of the past 7 days or so.
Sure. You're absolutely right, Tim. And, you know, this is just a good reminder, ladies and gentlemen, market corrections are a normal and healthy symptom of any long-term bull market. This is going to sound crazy, but we love market corrections. Why? Because it creates sustainability in the long-term move in the markets. If we just go up every day, what that essentially is, ladies and gentlemen, is think of putting a pot of water on a stove and then putting it on high so you can cook the food faster, and then just leaving the room. At some point, the water is going to boil, it's going to go all over the stove, and it's going to create a mess. When asset prices just go up every single day with no downward moves to sort of offset and keep things balanced, that's when the real messiness impacts us in 12 months from now, 24 months from now. This is healthy. This keeps us honest. This keeps us in check. This takes the froth out of the system. It acts as turning the temperature down on the stove or taking the pot off for a little bit to let it simmer down. That's good. We want to see that. We're attacking these little mini bubbles one thing at a time. That allows the overall market to continue its migration upward. So the message here, stay focused on companies that can grow long-term enterprise value. That's how you'll make the most money long-term. The credit markets are rock solid. And please, please, please do not get lost in the short-term noise of the market or the media. That's the ultimate transfer of wealth from the impatient to the patient. We want to be patient investors over time. That's what will lead to those performance numbers that, you know, we saw last year with our strategy, or the year before that, or the year before that. We just try to be patient. We're not trying to recreate the wheel. We don't do anything super sexy here. We just try to buy companies that are good, getting better, and then coaching clients on the behavioral aspect to give them patience so that they can realize that value over time. So Tim, thank you again for joining us this week, and to
Thank
our
you.
Absolutely. And to our clients and advisors, thank you again. Your patience is what makes that performance possible. The fact that, you know, every single time we have these drawdowns, we get fewer and fewer phone calls is a testament, I think, to how well our clients are receiving our coaching. And we just really thank you from the bottom of our hearts. And if anyone has any questions or concerns, definitely feel free to reach out to our team. We're here to help. We're here to help you grow, and we grow with you. The questions that you give us help us grow as professionals and as investors, and we get a lot of our great ideas from our clients. So stay in touch and have a fantastic week.